Hello and welcome to the Defining Your Niche podcast, where we explore alternative asset classes within commercial real estate. I am your host, Thaddeus Campbell. He is my partner at Safe Storage USA and FlexPark Partners, Russell Nursisoff.
Morning.
And we wanted to bring him on board to kick off. We are rebranding the podcast in honor of our move into the small bay industrial flex area. And Russell Nursisoff, you and your partner, David Hanses, were critical in that decision to go into small bay flex. First of all, welcome.
It's good to be here, man. Good to be.
I always love hanging out with you. You know, we have amazing conversations about real estate, but I really want to start with a little overview of what we're going to be doing here, which is over the next months and years, we're going to be talking about all aspects of commercial real estate. And this is really geared towards people that maybe are a little newer in the space, maybe haven't been in commercial real estate at all, and kind of giving you a roadmap and a guide using some of the mistakes that we've already made to hopefully help other people avoid them.
Sure.
And then also areas we've been successful. But before we really dive into that, I want you to tell me a little bit. We decided to rebrand this podcast because we're not moving out of storage by any stretch of the imagination, but have decided to dive into the small bay industrial flex space. I want you to tell me a little bit about what small bay industrial flex is and why we decided to go into that space.
Yeah, man, for sure. A lot to unpack here, and let's take step by step, and let's help our viewer to see the rationale behind what we're doing and the logic behind it. So, why flex? In the last, I would say, 3 years, it became apparent to me that it's a lot more difficult to compete today in the self-storage space, which is what we've done historically. This is what we're doing, and this is where the area of expertise that we built and created just by doing deals over and over and over again came from. But it just really intense in the market right now, and there is a tremendous gap between bid and ask. And you and I talked about it in a prior podcast, but I'm just going to kind of summarize everything that we already said in terms of self-storage market. So it is a lot more challenging today, and it has been challenging in the last few years to identify and to be able to close on the property. Why? Very simple. Self-storage became incredibly popular. I was going to say niche, but it's no longer niche. It's becoming an mainstream investment asset. And we see a lot of institutional money coming in. We see a lot of Wall Street money coming in. We see a lot of insurance companies running after the asset. Why? Because it has been proven as a I wouldn't say recession
proof.
I would say recession resilient asset, and it's been performing really good in an up and down market. And there are different reasons for it. We're not going to go into a lot of details, but when people moving up to a larger house, they move from place to place, they need a storage. When people downsize from a larger house to a smaller house in a bad economy, they also moving, they need a place to store their things. So it's just one of those assets that are really has been showing a resilience and has been performing very strong. There are some issues within the asset. The occupancy dropped down. The rates are not as strong as they used to be, and the big boys, the REITs, publicly traded REITs, they playing their strategy, their games, and which is affecting us in a way. But overall, it's been phenomenal asset. However, we're not the only one running after the asset, and there's a tremendous competition within the industry to if you wanna purchase the deal. Unfortunately for us small business owners, the larger groups are willing to come in and take a look at the assets that we own now, which are primarily in the tertiary markets, where they were not fishing in those waters before. But today, they're more than happy to come in. And us being the best example I could give you, we recently sold a deal in Wisconsin, and a very large privately held privately held company came in, multi-billion-dollar company, by the way, came in and they bought.
Top 10 owner in storage, right? They're cream of the crop.
And surprisingly, they were interested in the asset, and the reason for it, because I think even for them it's very difficult to find larger assets where they can see the yield, where they can see they can make profits, and they can generate significant return for their investors. So they are slowly moving downstream to where we operate, meaning in the strong but tertiary markets, which was a good indication for us to understand where this is going. And we're like, okay, well, it's going to be more and more challenging to compete. What do we do now? What's the next step? Where can we go? What else can we do not to? Because the last thing you want is you want to be stagnant. You don't want to be stagnant, actually. You want to continue to make deals. You want to continue to do deals. You want to continue to close on properties. But as I said many times before, you only want to do it when all the conditions are right and where we know for sure that we can make money for our investors, and which is for us as a group, as a Safe Storage USA and We Buy Flex, is the most important thing. We work for our friends and family that are entrusted us with their hard-earned cash. So we need to make sure that we can generate a healthy return for them. Which brings us to the point of flex space. So flex industrial, by definition, is a very, very broad asset. There's a lot of niches within that asset. What we try to concentrate on is primarily small bay, multi-tenant industrial flex space. So let me explain to you what that is. It's the concept is very similar to storage. Actually, a lot of times it even looks like storage. But the difference is that you're not renting to a regular individual, you are renting to a business. Now, there are pluses and minuses in doing so. So the good thing is that the businesses tend to be more stable, and they tend to be, they usually have an ability to pay the rent and whatnot. The downside is that, unlike in storage, where the leases are month to month, here we're dealing with annual lease or 3-year lease or 5-year lease. So your upside and your ability to raise rents are limited by the structure of that lease.
Some might say right now, with what's going on in storage, that's an upside, right?
It might be a good thing, but to us,
historically, that's not been the case, because storage was like on a 40-year trajectory straight up. But the last couple of years has been a little different.
Correct. So to us, we see a lot of benefits. We see a lot of symbiotic relationship with the storage. And what actually happened in one of our facilities that we have in Maine, we have a whole section of the facility that are actually built as flex. And those units are significantly larger. They are, I believe, 13 by 30 with 16-feet ceilings. And what we notice is that we have very steady tenants there. There's not a lot of move-ins, not a lot of move-outs. They like the place. They tend to take a very good care of it, because that's their place of business.
Yeah.
And that was the attraction to us. We also feel that there is still an ability for a smaller group like us to go in and make and mark on in an industry where it's not as competitive as it is in self-storage. Now, as a side note, we're not abandoning self-storage. We're looking for deals on a daily basis. We're underwriting, but we also going to be we also, as a group, we made a decision to be open-minded and to explore other assets, and in this particular case, definitely flex space.
So tell me specifically, you said that you see an opportunity within flex. Not that there isn't still an opportunity in self-storage, but and by the way, you guys, a few weeks ago, we did a wrapping up 2025 episode of the podcast with Russell. You can go watch that, and he goes even further in depth about that. But we've highlighted the greater challenges within storage. What was it about Flex that made you guys believe that there was more opportunity here, that you were going to be able to compete at a more realistic level to find deals that actually cash flow instead of buying things like we're looking at in storage right now, which you have to be at negative leverage to compete on the purchase price?
Negative leverage. It gives me
By the way, I'm using terminology and we're really gearing this to people who maybe don't know. Explain the idea of negative leverage and then answer the question about why do you think the space is a little more open in small bay flex?
Okay, well, lots of to unpack here. I think
My
I think we
goal.
should
I want to give you a lot to unpack, then
I
I don't have to
think
talk that much.
I think we should start from explaining why we're doing this podcast, right? I think we should start by telling our viewers the reason behind it. So we want to do this for anyone who's entering the space, whether it's storage or flex space or any other assets within the commercial real estate. And we want to be able to give you guys the answers. We want to be able to give you the path. We want to be able to prevent you from making mistakes that we made. We want to be able to make it somewhat easier for you if you are on the path to enter the realm of the commercial real estate investing. Now, there's going to be many terms that we're using. Thaddeus just said negative leverage. We're not going to assume that you guys know, all of you know what that is. Okay, so we're gonna as we go along, we're gonna try to explain it. But as we move forward with the podcast, with every podcast that we're gonna make, I think we're gonna talk about step-by-step process of how to find facilities, how to identify facilities, how to fund facilities, how to manage facilities, how to run them, how to do the value add, how to make facility worth more money, how to refinance facilities, how to make money in real estate, and I think we're gonna take step by step by step. But to answer your question, the negative leverage is very simple. That's when the cost of funds for you to go when you borrow the money is higher than the cap rate of a going in initial cap rate on the property. Now, it sounds simple, but it's really not that simple. So we need to unpack a little bit more. So the cap rate is the return, cash on cash return that the property generates, assuming that you don't have debt. So it's, let's say a property generates $100,000 after the expenses, but before that. And you're buying that property at $1 million. That assumption makes it a 10 cap deals because it's 100,000 into 1 million, it's 10. So, but let's, if we continue with the same example, let's assume you want to finance this property. You go finance the property and the bank tells you, hey, we're going to lend you the money at 12%. So the cost of funds will be higher than the cap rate that you generate, the return that you generate on the property. That's called the negative leverage. Probably not the best case scenario for the beginner, for the investor that's just trying to get into the business, because you're not losing money from day one, but you are underwater somewhat, meaning you need to do a lot of value add really fast. You need to bump out the rates. You need to get a hold of the expenses. You need to manage them better, reduce expenses, increase income to get to the point where you are at least not losing money and you're able to be on par or higher than the cost of the borrowed funds. So that's the answer to the negative leverage.
And we've seen that in storage, right? You mentioned one of the top 10 owners buying in Sturtevant, Wisconsin. The reality is a lot of those big companies, the REITs and private owners that are really large, they have a bunch of capital on hand from years of success in the business that they don't need to borrow as much from the bank, and they can afford to pay a little more to bury some of their cash. That if you're trying to leverage the bank as much as you can, you just can't compete.
There's another thing that I've noticed. A lot of larger funds, larger groups, they raise funds. They raised a significant amount of money. Now, whether they paying their investors right away on that money or it's all compounding in the background, I don't know the answer to that question. But they do have an ability to go in and purchase the property in cash. Literally, so you're competing against not only somebody who's got a lower cost of funds altogether, and they can offer more, but they can also close faster, and they can buy the property in cash. So if you're the owner, which offer would you consider more? Somebody who's asking for 30, 45, 60-day due diligence and then closing another 30, or somebody that's closing in 4 weeks, cash deal, no contingencies.
Yeah.
So, but these guys are very smart. Not only they can buy it in cash, but they have an ability to sit on their property for a year or two or three, do their value add plan, raise the rents, get a hold, get a control of the expenses, and then refinance out of their property and get all the money out, whatever they put in, and have a cash flowing asset. Fantastic strategy if you have an ability to do so. And these guys do, so good for them. Once again, another reason why it's a lot more difficult to compete in the self-storage space today. Which brings me back to the question you asked me before, why Flex? We as a group, we feel that Flex is not as competitive as self-storage today. My gut feeling that it's not going to be the case for much longer. I think there is a lot of people talking about Flex, a lot of people talking about getting into Flex, and the money usually goes where they treat it best. So, I think in today's market, at least for now, you can generate higher yield in Flex space versus self-storage. It's not as competitive as self-storage. There's not as many buyers as self-storage. And unlike the proportion of mom and pop, what we used to call it, is meaning somebody who owns 1 or 2 or 3 facilities in self-storage compared to the private or public REITs or larger groups, which probably today, that is, we were talking about a couple of days ago, it's somewhere around 40% now.
Yeah, and if you start extrapolating out like really small deals, those deals that you and I wouldn't want to buy because
Right.
they're small and they're not going to cash flow enough to make any meat anyway,
Right.
it really goes up to 60, 70%. That it's just the days of mom and pop being a
The
big,
majority,
it's gone,
owners.
long gone.
And if you look at the Flex as of right now, yes, there are larger groups that own millions and millions of square feet, Prologic and whatnot. But we're not competing with these guys. We're not going after a 1 million square foot single tenancy property. We're going specifically after multi-tenant, small bay industrial Flex space, and the competition.
Explain what that looks like to me for somebody who doesn't know. When
So
you say, go ahead.
Good question. Good question. So, small bay, a multi-tenant. Let's take as an example 20,000 square feet building, right? Imagine if just to make it simple, is broken down into 10 2,000 square feet units. So every unit is consisting of 2,000 square feet of a warehouse. Now, the beauty about Flex space is that it's so versatile that it can accommodate limitless amount of businesses, number of businesses, and types of businesses. Anything from a dance studio to a plumber to electrician, pool guys, lawn guys, like gyms. I've seen boxing gyms. I've seen CrossFit. I've seen dance studios. Even doctors' offices, if the zoning allows. So the variety of businesses you can approach and that there are potential your customers, your clients, is very, 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 very large. Now, usually that 2,000 square feet space consists of a small office, which is about 10% of the space. And that small office usually has either air conditioning or heating ability. And the rest of it is just a warehouse. So, like I said, it's very, very similar to self-storage. It just gears towards small businesses.
A little different than going and building 1 million square. I live in New Jersey and go up and down the Jersey Turnpike all the time. And really, this is an interesting point for those of you that are learning. I spent the last 25 years driving up and down the Jersey Turnpike watching these $1 million facility or 1 million square foot, $100 million facilities get built for Amazon. And I literally did 2 weekends ago, Amazon and Wayfair, 1 million square feet each, sitting right next to each other. That proliferation of those large industrial buildings really kind of is one of the reasons that you're so excited about small bay flex, because it's kind of been forgotten about for the last 20, 30 years.
Well, let's talk about why. Because I think it's interesting to know that flex by itself as a business idea was very prominent in 80s and 90s, There was a lot of flex built. Even right now, if you do a search on the CoStar or LoopNet or Craigslist, you'll see a lot of that product was built in mid 80s all the way up to late 90s. But then it stopped. And the reason why it stopped, because it became cost prohibitive to develop. And naturally, when everything, where actually something works and attracts a lot of attention, a lot of people went in, and it got overbuilt to a point where there was no need to build additional flex. So it is rare to find a vintage, a newer vintage flex space park. There are some. There are parts of the country, specifically in Texas, Dallas, Fort Worth, Houston, San Antonio, where it's been an ongoing process. But mostly across the country, you don't see a lot of new product. And the reason why, because it's very, very expensive to build, number one. And number two, the land cost. Land is one of the largest components, and unfortunately, there's just not a lot of it. And there's not a lot of deals that actually work. And that is, you know this better than anyone else, because this is what you do on a daily basis. You're looking for land for the group. And it's very challenging to find place that works, to find place that can give you the rents that you need to be able to support the construction and to be able to, and it is not common to find that area. Now, we were lucky enough to find, with your help, to find that place. We're working on a project right now in New Jersey.
Not supposed to talk about that. We're supposed to keep that quiet. We don't want to jinx that.
No, I'm not giving any details.
You taught me the lesson. That's great.
But
I'm gonna chime in here because I want to say something just to illuminate your point a little bit, shine a little light on it. I was looking at a project, a boat and RV storage in Fargo, North Dakota. Now, for boat and RV storage, we need less than $2 a square foot. Flex, similar, like we might be able to get to $3-4 a square foot for the land.
right.
Fargo, North Dakota, you're talking like the end of the earth, as cold gets. $8 a square foot for land that's zoned still agricultural. In other words, it's a farm. It's
Yeah, you
still
got a
off the
rezoning. You got to do the variance. You got to go through the whole thing.
$8 a square foot they want for the land. So you talked about land cost, and I want you guys that are listening that are maybe newer in commercial real estate to understand the greatest way to kill a deal, right? You make your profit on the front end of every deal, whether you're buying something new or you're a ground up development or you're buying an existing building. Your purchase price is always going to be where you get the most value in your deal. And of course, if we're doing ground up development, that means making sure you find land at the right cost. Do not chase land for the sake of getting a deal. It will kill you every single time if you're overpaying. That's my little blip but just to show you what it is, we need $4. It's trading for 8 in Fargo, North Dakota, which is the definition, by the way, of a tertiary market, right? That's as
Very
tertiary it gets.
Yes. Well, good point. Good point. Which goes to say, to the point I was trying to make earlier, it became very difficult to pencil the deal, and that's why you don't see a lot of product of 2010 vintage. So even now, I mean, it's the construction costs went up ever since COVID, and but the rents also went up, and you and I talked about it. I think yesterday or the day before, we looked at the property where the rents 2 years ago where they were asking $10 triple net. Now they're asking $14 triple net, and that's 40% increase in 2 years.
Right.
So
Yeah.
I think we're going to see more and more people getting into new development, just for the simple reason that it's somewhat challenging to find a deal that actually works because big money are moving in, and once big money moving in, it's going to be a lot more difficult and a lot more challenging to find deals. So, I was talking to a lot of brokers, and I was talking to a lot of people in the business for the beginners, for new investors, which you guys might want to concentrate on. Look at the smaller projects. Don't look at 40, 50, 60,000 square feet business parks. Look at 10, 15, 20,000, single building, 5, 7, 8, 10 small bay flexes, and just to get your feet wet, so you can learn the business. It's easy to manage. It's a lot less money going in.
Yeah.
By the way, talking about going in, I've been talking to a few banks recently in the last couple of days about some of the projects we're looking at. Banks are very, very proactive when it comes to flex. They like the asset. They feel it's safe. They know there is a very low default rate on the flex, just like there's very low default rate on the storage as well.
Storage.
So storage flex, just like I said, they go hand in hand. They're very similar. It's
It's going to
funny.
be
We've seen a couple of parks where some part of the park was the self-storage and part of the park was the flex space,
flex.
So sometimes developers want to combine them and just to protect the downside, I guess. But I think as a beginning investor in the commercial real estate, this would be one of the better opportunity right now, just to go into smaller flex buildings.
So this is a perfect opportunity for me. We kind of went at this backwards. We didn't start off by giving you kind of the resume, the curriculum vitae of why it is you might want to listen to us and believe in what it is we're going to try and teach you guys. I want to dig into a little bit of Russell Nursisoff now. Your partner David Hansis, who I'm sure we'll goad him into joining us here someday, but. You've been involved in real estate in almost every aspect, residential, commercial, multiple different asset classes. Give me a little bit of your background in real estate, how long you've been dabbling in real estate, and why it is that somebody might actually want to listen to you.
Um, so I'm a chiropractor by training. I've been practicing for 23 years, and during that practice, during all these years, I had a real estate license because I was involved in real estate in one way, shape, or form um, for the biggest part of my life. Like many of you guys, I started out in single family. I think it's a very common path to anyone who read the Rich Dad Poor Dad and study Robert Kiyosaki, and that's the guy that changed my life and changed my view at the world. So I started in a single family like most of you, and from that I went into land development, conceptual land development, and done plenty of deals in Southwest Florida. Um, when we were taking a land, getting all the permits and getting all the designs, architectural designs, and taking it all the way to a point where you can start building. But we were not building; we would just sell it to the either developer or to the end user because the market was so hot back in the days. From that, I went into multifamily. I think it's a natural progression. I became very much involved in the multifamily investing, primarily out of Texas. I joined a few masterminds. I learned about multifamily, done some projects, went in as a limited partner, then as a general partner. As the business was growing, as years went by, multifamily became so hot that I realized that sooner or later it's gonna blow up, and I sold all my deals basically. I sold all my shares in the limited partnerships, and from that point on, I started to look for other asset classes, and that was in 2020, beginning of 2021, when I came in to a world of self storage by joining another mastermind with Mike Wagner, where I learned a lot, and I met a lot of good people there. I met a lot of investors, and that's when I learned one very important lesson is that not every investment opportunity is for everybody, meaning that the deal might not work for you, but it might work for me, and vice versa. And I was given an opportunity coming from a fellow member of the mastermind to purchase a large facility out of Michigan, Midland, Michigan, and the deal didn't work for him and for 11 other people that looked at it. But somehow we were able to uncover maybe some other things that were missed, and my partner David and I, we closed on it in the very early 2021, and that was the beginning of a self-storage journey. And we've done, between 21 and today, we've done a number of deals. We've done 6 deals. We've exited. We went full cycle on 3. We wholesale some deals. We still own some deals. We are at the point where we need to either grow that portfolio or look somewhere else. And we actually made a decision to do both, and we made a decision to bring other members into the team members into the group. And Thaddeus came in.
For which I'm thankful, I might add.
Thaddeus came in about a year ago, bringing his expertise with the land development, the new construction. We have another broker that works with us on the flex side. We brought in underwriting in a house. We brought accounting in a house. We brought a management in a house, and we built a team, which is something that we're going to do a separate podcast altogether. Because rule number one is who, not how, right?
1,000,000%. Yep.
We're gonna talk about it because I think it sounds overwhelming, and it sounds like, to somebody who's just starting, their journey, it sounds like, oh my God, they have a team, they have access to funds, they have knowledge, this and the other. It's easier for them. So I'm here to tell you, it's not easier for us.
No.
It's just as challenging as it is for you, except that we have a system in place, and in order for you to have that system, you need to know who to bring on your team, who to have affiliation with, who to build relationship with, so you can build success in your own practice. But yeah, that's
I'm just going to chime in here and say one thing you will never hear Russell and I say is passive income, because there is nothing passive about the income that's generated in real estate. Even if you're an LP, even if you're investing in another deal, someone's doing a whole bunch of work for that deal, and as an LP, you better know who that someone is, and you better trust that jockey that's riding that horse to get that thing across the finish line, because there is no such thing in real estate as sitting back and watching the checks flow into your door. That is not the reality of what we're doing, and quite frankly, isn't the reality of anything that makes money over the long haul, which is really what we're trying to educate people on and help people be able to accomplish. It's not about winning the lottery and hitting something in the short term. It's about creating a life that you can sustain over time and being able to create income over the long term, which nothing has been as successful at doing that for people over the history of the United States as commercial real estate.
Other than Bitcoin, I would say, but that's
history of the United States.
Bitcoin's been around for 15
years. Listen, this is a perfect break point. We've been a little over a half hour now. We want to make sure these are digestible for you guys, that the information is something that you can absorb and you have a little bit of time to digest. I am going to promise you guys that we're going to tell the story of Russell and David's Midland, Michigan deal and a couple other deals that they started off in their storage career, because there are a ton of lessons to learn about them. And the biggest one for me and why I work with these guys is how humble they've been, even with the success of those deals. I'm going to tell you right now, they hit a home run at their first at bat, and we'll dive into that in the next episode that Russell joins us. For now, Russell, thank you so much. As always, it's always the half hour always flies by every time.
Always flies by. Well, it was great to be here. Thank you for having me. I'm looking forward to our next one. We're probably going to do it on a weekly basis, I would assume.
Going forward, people will be seeing you weekly for sure.
That's our commitment to you guys. And as that is, what's the easiest way to reach out to us?
100%. Russell's at russell@safestorageusa.com. I'm at Thaddeus@safestorageusa.com. You want information about our group, go to safestorageinvestors.com. You can also go to flexparkpartners.com. Those are all of our relevant links that you can get to. We are always looking for deals, whether it's self-storage or small bay flex. If it's a piece of raw land that you have that you think might be of interest, shoot us an email. You can follow us on social media. We're all over. You'll see on the bottom our LinkedIn and our Instagram and all the different ways that you can get a hold of us. I am certainly omnipresent, and Russell is almost as omnipresent as I am. I spend a significant amount of time on social media, so not that hard to find, but all the links will be there for you guys. We are always, as I said, always looking for deals. And more importantly, we're always going to pay for good deals. There is enough pie to go around. So if you bring us something, know that we're going to make sure that if it's a profitable deal and we buy it, you are going to get remunerated. You're going to get paid. How about that? You're going to get paid for that deal.
You're going to get compensated, I think.
You'll get Russell saved me at the last minute. You will get compensated. Listen, really excited. This is the very first episode ever of the Defining Your Niche podcast. So excited about these two asset classes that Russell and I we didn't really talk about this, but every single person we talk to in both of these asset classes, to a person, really, really good people. So if you are looking to get into this journey, know that you're going down the right road, at least as far as the type of people that you're going to be interacting with. That's all for this week's episode, and we'll see you next week.
We'll see you next time, guys. Take care.